Hi, I'm Vishnu Srinivas, and welcome to Hawkeye. I started this podcast to give professionals an open platform to share their candid views on topics impacting businesses and economies around the world. Make sure to rate, review, and subscribe. Joining me today is Hugh Hendry. He is the co-founder of Eclectica Macro Hedge Fund. Thanks so much for taking the time to speak with me today.
I have to correct the conjugation of your verbs. With regard to that introduction, that would be very much in the past tense. I ran a hedge fund for 15 years. I no longer, I think that is my superpower. I'm not looking for other people's money to manage. So I can tell it like I see it.
Unfortunately, I didn't want to use the past tense and make it sound as if you were dead, but it's all good.
I died a long time ago in mortal combat with the financial markets. But unlike the Great Gatsby, I do believe in a second coming.
Love to see that. So the second coming, I hear, or rather I see on your website, hedge fund manager, hotelier, investor, surfer. I even see some skateboarding. Is there anything you don't do? How do you find the time to do all of this?
Well, it's very important to become younger. Doesn't just happen. You have to make it happen. But the remarkable aspect really is that as much as I try to run away from these markets, there's this damn thing called experience and constant like subconscious processing. And so I find myself opinionated. And thankfully, we have platforms like yours and mine, which offer ample opportunity to spread the message of asset capitalism.
That's what we're here for. And let's talk more about that because, I've talked with many guests in the past, namely Cliff Asness, and he just hates this designation of hedge fund for, as a catch-all term for his asset management. He thinks it's such a loose term. I guess, how would you describe it in the context of what your company was?
I like the label, the guard dogs of capitalism. You step out of line and you're going to get an opinion back at you. And sadly, we're in a world, we've been in a prolonged world where there is an elitist orthodoxy of how the economy is supposed to work. And that supposition comes through the economic models of central banks and grotesque institutions such as the IMF. And they haven't worked for like 2 decades. And actually, the macro community, I mean, I kind of put a nail in my coffin in 2013 saying, you take the money, you don't need hedging or whatever that means. Hedging is not beta one investing. It is the willingness to be derided for underperforming the beta one equity indices, because you're trying to do other, the mandate. So you were talking about hedge funds, but actually macro is far more engaging because every other investment strategy, it tends to revert to a beta one dope, like you're a health fund, hedge fund, like, or you're small cap, or you're like Japanese equities, or your private equity. And so when the tide is very much in your favor, then you kind of get a free beta one kind of exaggeration of your skill set. You're not afforded that luxury in the world of macro because quite literally you can do anything. Typically with the refrain, you can do anything, just don't lose money, and kind of be interesting. And then that hard one, try and be uncorrelated. And being uncorrelation, low correlation, negative correlation is like a sexual disease when we have rampant financial asset inflation.
Yeah, and you talked about it, but the concept of macro and hedge fund is kind of novel. Like when you first founded Eclectica, what was your vision like in terms of how you wanted it to go in this direction, and did it pan out the way you expected?
Heavens, good question. So when we go back a long time, hence I'm tripping over my words, a long time. I set up my hedge fund in the fourth quarter of 2002. I was engaged within a hedge fund partnership managing a long-only mutual fund in the kind of electric kind of NASDAQ crash type period of 1999, 2000, 2001, and running it effectively like a hedge fund. But back then, the industry was in its infancy. It required an 80% drawdown in a major asset class like the technology indices in the United States to reveal the inadequacy of portfolio management skills to protect precious client capital. And so the stimulus, the thrust for allocations into hedge funds only began thereafter in the years 2003, 4, 5, and of course only got greater. So when I started, I look back more to kind of the swashbuckling kind of pirate type endeavors of effectively macro funds, the Soros escapades with Jimmy Rogers et al. In the 1970s, where they could swing and be cavalier and take on governments. So that was very much I was recruited as a pirate to take on the status quo.
What an analogy. We're going to need more of those coming because, as you may or may not know, many listeners might know, this has turned into by accident, a Fed bashing podcast where guests regularly come on and are not afraid to be vocal about their distaste of central banks. So let's see if you're next in line, because lots of people, most recently I had Tuomas Malinen on the podcast, seem to think central banks and the Fed are ironically the problem and are exacerbating issues like inflation and banking crises. What say you?
Well, that would sound as though you're hanging out with the cool kids, because that is not a widely disseminated view. The widely disseminated view via the insanity of the front pages of the financial press are very much that these guys have got it. Central banks, with the evolution of the euro-dollar system. What is the euro-dollar system? It is the ability of commercial banks, private banks, operating outside the sovereignty of the United States, but yet being able to create dollar money, to print dollar bills via the exercise of commercial loans to other parties. And that really took off in the 1970s. I would say its dramatic expansion in the 70s very much underwrote the peculiar and sustained inflation of that period. But you have to recognize that we're talking about a system which is unregulated by the Federal Reserve or any other central bank. It's a dark web, unregulated except regulated by your reputation with your counterparty. And so quite a loose system where you're allowed very generous levels of leverage. Yeah, again, like a hedge fund with the adage, just don't lose money, and God forbid you lose your reputation and the money will be taken away from you. And what we have seen in the last 2 decades has been collateral calls coming from this unregulated banking sector, which is, it would seem, way beyond the purview of the Federal Reserve to comprehend. And the momentum of these waves of collateral being pulled back and withdrawn from market participants has created wild swings in equities and other risk asset classes, which largely now seem to resemble a volatility machine. So Fed bashing, the Fed bashing is simply that they have to, there's a pretense in their omnipotence. So again, if I was to kind of try and say sensible things, there are three forms of money. I'm going to begin with the second form of money because it's the most widely understood. That would be onshore bank deposits, which are liabilities of the banking sector. And therefore, with liabilities, they seek to match with assets, which would be loans. And again, banking sector loans would represent the creation of dollar money. That money is, again, regulated by the Federal Reserve, and it's insured by the United States Treasury. But at the margin, that's become less and less important. And since effectively the bankruptcy of the global financial system in the aftermath of the shock of 2008, that has not been a conduit of monetary creation. Banks have been very, very reluctant to take commercial-faced risk. And so you found the Federal Reserve relying upon the first form of money, which is a pure public form of money, which comes under the title of banking reserves. And so the Federal Reserve has engaged with commercial banking entities and sought to purchase US treasuries from them, and in the process create bank reserves with the hope that, armed with these, I mean, it's like giving kids alcohol, you know, it's like, this one's on us, it's on your uncle. But the kids are like, oh, dude, like last night was so heavy, 2008 was so heavy. Like, I really, no, yeah, it's just sat there. The drinks cupboard is sat there like full of alcohol, and no one's really touched it. But that's this is the theater, I call it the theater of the absurd. This is the quantitative easing, and this is, hey, we're doing something. Back in the thralls of the COVID, you had Jay Powell saying, yeah, we're printing money. Look at these bank reserves. Well, bank reserves are effectively tokens. Like if you go to Starbucks, why would you go to Starbucks? But let's say you go to Starbucks and you have a flat white, maybe with oat milk. But if you offer to give them a token, they're like, get out of here. Yeah, we're looking for money. Okay, so that's a thing. So the only form of monetary creation, or the dominant form, has been this third form, this pure grade, uncut private money, the Eurodollar system. But it's had no appetite for investing in inventory, factories, et al. But in seeking to money seeks to perpetuate itself. It's like your genes, you're out there like having sex, you want to have babies so that your genes will persist. Well, the sex in Eurodollar is the investment in asset price inflation. Asset price inflation, if you will, is creating the babies. It's the perpetuity. It's the more and more money, which brings on more and more loans. That's where the action has been. But we're at a crunch point today, which is either a lack of understanding and wisdom with how that system operates, or just policy error and neglect. But we're chipping away at asset values. Asset values are retrenching, and therefore there's a fear which is expressed in the curvature of the US Treasury markets that this is shaping up to be a very, very predictable policy error by central banks, and that we will be engulfed in really a momentous economic decline. Time will tell.
Yeah, we definitely need a quote graphic for all those immaculate gems you just dropped during that segment. But let's dive deeper into, one of the concepts you were talking about, which is, private banking, because, central theme we're seeing is that these debt levels, credit risk, they're all at really high points, especially when you're looking at what's going on in Europe, European banking. Do you think this is untenable long-term for a market that's looking to reduce inflation?
It's not untenable in terms of reducing inflation. So how to address that? So let's do compare and contrast, show and tell. I don't quite know the specific figure, but public debt to GDP in Brazil, okay, is going to be way below 100%. And if you throw in commercial, maybe 1.5 times GDP. The comparative figure for the US would be like 3x. Ever since the advent of that first pure form of public money, quantitative easing in March of 2009, people have run these articles where you have a kind of sepia brown picture of a German man with a hat, and they don't wear acid capitalist trucker hats, they wear bowler hats. They've got a wheelbarrow and they've got money. And like, oh, it's going to happen again. It hasn't happened in the developed economies because of the sheer magnitude of public debt markets, which means independent of interest rate settings by, 10 blocks constituting the Federal Reserve, and its monthly or 6-weekly meetings, markets are constantly repricing credit. And so when there are these episodic moments where participants are fearful that credit conditions are too generous, rates tighten independent of the Federal Reserve. And if you will, that's a reflexive pushback on the household sector, which is faced with the unpleasant decision of continuing to spend or cutting back via the means of discretionary expenditure. And so I find myself still pushing back on the inflation, which is almighty this year. I guess my pushback is on the sustainable nature of that inflation in a year where US Treasuries, in 18 months, US Treasuries have gone from like 50 basis points to over 400 basis points. UK yields like over 5.5%. And we're seeing asset prices versus GDP, so a stock determinant, falling like 200% of GDP. Typically, that's the portent of profound economic uncertainty and weakness. And typically, that is the sunshine which soaks up the puddles of the bountiful puddles of the elevated prices that we see today. But yeah, that's conjecture on my part.
Yeah. Yeah, totally. And you talk a lot about, quantitative easing and how, related to post 2008. Do you think there's to an extent, some revisionist history as to just how effective it actually was in resolving that recession? Because, in the coming months, as we expect to have an economic slowdown, there's many proponents that we should bring that back.
Quantitative easing is just simply a pretense. It's a bit like you go to the office, there's nothing to do, you sleep, but your boss says, "What have you been doing?" You go, "Oh, quantitative easing." Look, I mean, 9 trillion. I've issued $9 trillion in 15 years. I've been hard at it. Okay, so what do we have to show for that? So quantitative $9 trillion supposedly of new dollars. So dollars are 9 trillion more plentiful, yet the dollar is higher. That's kind of tricky. I've done really loose monetary policy. Okay, but the trend rate of GDP has been really suboptimal versus the previous 30 years. There's been a profound policy failure to regain the traction of like 2.8% GDP growth. We've got nowhere near it consistently in the last 15 years. So it just kind of feels like it's it's getting wider currency now, but the analogy is the Wizard of Oz. The Emerald City is not green. There's a pretense. I don't know if you don't really see it in the book, but everyone's got to wear Panglossian sunglasses that make the Emerald City look green. You take the sunglasses off and you're like, really? What have you guys been doing? Nothing. So they can turn it on, they can turn it off. I don't think it really matters. I'd also say that in terms of the asset price inflation, so that we have had inflation, we have had consistent inflation in asset prices, and of late, we have had very, very elevated consumer prices. But the adage that it's a monetary phenomenon takes you to the path of quantitative easing and these mythical $9 trillion of tokens. But really, that's to divert the attention from mercantilism and the profound transfer of wealth from the balance sheet of the personal household sector in places like China, where literally trillions of dollars have been taken from those households and parked into the very open and welcome capital markets of the United States and other markets like the United Kingdom. Now, when a deficit nation like the United States, which is not savings constrained, this is not the 19th century. The United States is not embarking on a profound rollout of canals, railway lines, chemical plants, et al. Okay, so its domestic investment spend is well covered by domestic savings. When you then transfer trillions of dollars of the Chinese household wealth into that market, you destroy price allocation, you destroy the pricing of money. And at the margin, an entrepreneurial economy becomes a speculative economy. We're a speculative economy, which is now under the assault of interest rates, which are very much chipping away at the value of assets and collateral. And again, this is one of the reasons why there's such fear and loathing and hesitancy in the forward pricing of the US Treasury market.
Yeah. All right. Switch gears a second and put on your investor hat metaphorically, because there's a lot of hype surrounding the rising dollar. Are you buying into this, or do you think that the looming possibility of recession could possibly undermine this progress?
Okay, so education 101. Okay. The dollar will fall when the system has healed, right? When all of the pervasive gloom, I think legitimate fears concerning global GDP growth, when they abate, when the world feels more welcoming, when the collateral officers of the euro-dollar system are willing to accept, high quality equities et al. Rather than US Treasury bills, the dollar will fall, right? We're presently not there. And you said this awful term, hype. There is no hype. The dollar is trending higher. The dollar has been trending higher pretty much over the entire duration of the Fed's quantitative easing exercise. It's only now that it's gaining traction, and it's gaining traction because the momentum is rising. What's happening? Recently, the euro-dollars, I hate to keep mentioning this damn system, but it is the global finance spigot. Yeah. It had previously been willing to extend you unlimited credit on the basis that you would give UK gilt bonds, like risk-free government securities, and you'd take a haircut on that, and they would give you a line. The drug dealers, they give you a big line, right? And what's happened recently is they've gone, yeah, I'm really, really worried. I'm really worried about the economy. And these gilts, I want treasury bills. And so what's happening at the margin is UK gilts, or sterling, if you will, is being sold, and at the margin, treasury bills or dollars are being bought. And that's happening across the world. The yen weakness is the same function. Tokyo is an immense station for credit allocation via the euro-dollar system principally going into China. And again, you're getting margin calls or collateral calls on that universe, and you see yen weakness. Okay, the euro has been challenging parity versus the dollar because the principal form of collateral which has been accepted at the window has been the Italian 10-year, owing to the fateful and successful propaganda of the ECB in 2012, where they said, hey, look, Italian government bonds are as good as German. And for the euro-dollar system, they're better because they're more liquid. The German government has been a fiscally kind of conservative government, which is to say it hasn't been issuing much in the way of boons, the name for the 10-year. And the credit system, the thing that it appreciates most, the two things are security and liquidity. Italian bond market, I think, is it's the third most liquid bond market in the world. So at the margin, again, people going, time for me to kind of, my risk assessment has changed. And again, at the margin, I prefer that you replace your Italian or your euro collateral. And would you replace it with dollars? And so again, you're selling euros and you're buying dollars. This is what's happening. This is what's not recorded in the financial press.
Yeah.
That's
So
not hype.
yeah, but so how do you think what's going on with the dollar right now, how do you think that shit changes the narrative about gold? Because, you constantly hear from in the media that, gold is regarded as a safe haven investment. But doesn't that kind of feel like it's losing some of its luster because, it's so variable based on how the dollar trends?
Gold is a preposterous asset. I mean, is it even an asset? I mean, it's just it's a plaything. It's whimsical. It's actually, because it's so absurdly abstract. I mean, what is an ounce of gold, right? We're still capable of mining and finding and producing more of it. So it's not that its supply is, it's harder to say it's finite in the manner that gold bills would argue. Now, don't get me wrong. There's a time and a place for gold. My hedge fund career was kicked off by making a calendar year gain of 50% in the year 2003, when gold was emerging from a quarter century of the most hideous bear market imaginable. There's a time, but gold, funnily enough, gold's greatest period of outperformance, uncontested outperformance, was in the 1970s. Freed from the shackles of government influence and intervention, it went from $35 to 850 in the course of a decade.
Sure.
And again, I'd like to see that as kind of financial Dadaism. It's like, everything does, nothing works. My protest, I'm going to own this damn stupid thing. And so it feels like I'm reticent to make comparisons with the 1970s because the overall levels of debt and leverage in our political economy are just not comparable.
Yeah.
And therefore there are fire breaks. But in terms of that protest, like gold's kind of, you could see how it would have interest once more. And then there's the back and forward with Bitcoin. Like Bitcoin could be the new gold, right? So I'm not talking about crypto. I'm talking about just absurdity. And you start getting, you can get very fanciful target prices for Bitcoin, because there does seem to be a finite, the 21 million metric, but then they create different variations of Bitcoin. So who knows, but let's say it's 21 million. And so if Bitcoin could capture a quarter of the money that historically was hoarded in the absurdity of gold, if it could capture like 1% of the money that was allocated to tips, if it could capture 1% of the money that was allocated to commercial property, then you add them all up, you get a figure in the you get a very large figure, dollar figure. You divide it by 21 million, you go, ha. But Stan Druckenmiller, the genius of Stan, was saying kind of that works when you've got asset price inflation. And we've had asset price inflation, but we're presently in a period where we're getting asset price deflation. And so probably you swing back, and again, you swing back maybe in favor of gold. And then finally, if I'm trying to construe and say nice things about gold, gold has an intellectual and price correlation to real rates, long-term real rates. And we're getting to levels where the real rate looks as if it's fast approaching 2%. And that gets kind of tempting. It's not perfect, but it gets kind of tempting in the sense that I believe that given the absurd levels of debt leverage in the economy, it can only operate and we can only rebalance over decades by operating either zero or negative real rates, which is a form of invisible theft, from the political economy. But so gold, yeah, but for all of that, I could call it many names, all the names under the sun. If it starts price trending positively, I'd buy it. It's not doing that presently. It's periodically, it's on its ass. In terms of its surety, its riskless nature, well, tell that to anyone who had it as their risk-free asset in the fourth quarter of 2008, when a liquidation pool on the entire system took the price from close on $1,000 to $500. So, you lost 50% on your safe asset. So life's difficult. Finance is difficult. Hedge funds are difficult.
Yeah, that's the mantra in life. You touched on it just previously. Bitcoin, the bandwagon is somewhat back because people are believing that it's more stable than U.S. stocks right now, and dare I say, a new safe haven. What do you say? Are you on board with that philosophy?
Come on, we're talking nonsense. The attraction of Bitcoin was its very rapid rate of price appreciation. Bitcoin was offering a potential salvation for all the disenfranchised, for all the kids and the unfortunates that haven't been rewarded because they haven't owned assets. And so you're trying to get a leg into having assets, and someone's, your wealth advisor, you're a teenager and you've got a wealth advisor, bugger off. But you seek financial advice and I think you should, I think stocks might make you 5 or 6% over, and good luck on that, over the next 10 years. And I've got $1,000, 5% compound, really. Whereas Bitcoin, in that period, the COVID reflation period, Bitcoin was rising 5%, minimum 5% a month. And you're like, yeah, that's my thing, right? So, but at that time, it was like NASDAQ, the rise of NASDAQ at the end of the 1990s. It had profoundly high levels of volatility. Price volatility was 50%, which would be the lie, or it would take to task some of the things you said in your introduction, vis-a-vis security, safety, vis-a-vis the S&P.
All right. This is the last question for you before we get you out of here. We need to talk about oil because as the energy crisis just continues to keep trucking on, how do you feel like investors should approach the inherent volatility that seemingly is always going to be surrounding oil?
I'd push back on volatility. I'd just say that the latent, the implicit economic risk that you're underwriting when you own oil. And for oil, I kind of almost add all risk assets that I feel that I have. There are times when I just don't feel courageous. I don't feel the need to be brave. And this is one of those times because we have a grind lower in equity markets. And there's a supposition that the Federal Reserve may have to pivot and come back and try and underwrite, put a floor on asset prices. Mm-hmm. But it ain't with the S&P down 20%. Maybe it's with the S&P down 30, but kind of doubt it. Even 30, I think you would still be modestly up over the period encompassing COVID. Is it down 40? Is it down 50? I mean, when you start getting onto the wides, there will be a sense of anticipation. So my feeling is I really wouldn't wish to take reputational price risk in terms of I'm buying this on the view it's going to go higher until I was closer to levels of wealth destruction in popular equity indices where I could begin to imagine the Federal Reserve going, damn, Yeah, we're going to intervene again. So oil and other asset classes, I'm saying, I feel like S&P being down 20% is not a level which makes me wish to have a dalliance, wish to be flirtatious on the upside.
Well said. Thanks so much, Hugh Hendry, for coming with the unfiltered, insightful takes. Really appreciate it, man. Thank you.
That's asset capitalism for you. Don't forget, we have a weekly podcast